We love volatility in the market. So let me explain a little bit about what volatility is. Essentially, volatility is a measure of activity in the market in terms of a range of price movement. If there's a lot of price movement in a given stock or an index, it has a high volatility. A lot of movement, in other words, it creates a very high number in terms of volatility. Now, volatility is used as a very critical component of the Black-Scholes formula that figures out the price of options. So the Black-Scholes formula is used in option pricing on all of the websites everywhere where you do an option. So it's pretty important you understand what it is. So what we do when we look at the price of an option is we figure out what's the range of volatility that this option has gone through, or this stock has gone through over a year period of time. That range of price movement creates its volatility. Now this is called historical volatility. Now, historical volatility prices the option. Now, interestingly, the option price that theoretically it should be is often different from what it actually is. And the difference has to be calculated into another formula in the Black-Scholes formula. And the way it's calculated is to replace historical volatility with what's called implied volatility. In other words, historical volatility is what the option price should be, but implied volatility tells you what it actually is based on what's going on in the market. Now, here's why we love to understand this stuff. If we can get a high implied volatility on a company that we understand, if we already know what the value of that business is, it's a great opportunity for us to make a lot of money very quickly. The reason that we can make a lot of money very quickly with a very high implied volatility is really cool. High implied volatility essentially is a measure of fear that something's going to happen. Okay? Something's going to happen right away, so the market makers get really nervous and they start to cause you to pay more to buy insurance against that thing happening, and that changes the price of the option. So what we're looking for with implied volatility is an opportunity where there's a lot of fear, but we're not worried because we know what the value of the business is. If we can get that activity in the market, we can make a huge amount of money in a really short period of time just by stepping in right before the implied volatility gets changed from high to low. Now, the time when that happens is right before earnings. When everybody else is running for the hills, earnings are about to come out, you can do some amazing things with options by taking advantage of implied volatility. We're going to teach you that in the long run, but for right now, let me just tell you that it exists, that we can do it, and we just go in, make a trade at the right time, take the trade off 2 or 3 days later, and we consistently make $1,000 here and $2,000 there, and you can learn to do it too. Now, if you enjoyed this video, please subscribe to my channel and visit rule1investing.com for more content. Now go play.